the idea that there's going to be demand for homes that are pricing out over $400,000, I don't care what the interest rate is. I'm telling you right now, I don't care. They cannot afford these homes plus the expenses that go along with them. And it's just like I think our media misunderstands who lives in this country. Yeah, the top 20% drive a lot of consumption, but there's a limit to how many houses they need.
Thanks for joining us today on the Real Friends podcast. On today's podcast, we have Melody Wright. On the podcast, we discuss the state of the residential real estate market, the crazy things going on in Florida, the affordable housing crisis. We try to see through some of the mirages and data to better forecast the real estate future. Melody, thank you so much for coming on the podcast today.
Gordon, thank you so much for having me. It's a pleasure to be here.
So, what got you into real estate?
Well, I kind of fell into mortgage by accident, which is where I started in mortgage finance. I took a random project analyst job in September of 2006 at top 5 subprime originator. I didn't know that at the time. And just sort of, we were owned by GMAC or GMAC, who was owned by GM at the time. And we essentially, I started at the top, and we had been purchased by a private equity group, Cerberus, who came in and just wanted to understand everything about the business. As the project analyst, I kind of became their sidekick in terms of going out across this massive business, which incorporated many different companies to help them understand what they had just purchased. At the same time, the market was sort of, coming to a real stop. And, we started doing write downs after write downs after write downs. And so everything kind of went crazy. And I got a crash course in mortgage. I learned a ton during that time, but I didn't eat, sleep, etc. I lived at work really up until honestly 2013. That's how long it took us to get through the crisis. And it ultimately for us ended up in our bankruptcy, which I helped to manage, as well as I started out in corporate finance, found my way over helping to manage kind of the consent order, which is when the banks and non-banks got in trouble for servicing practices, and then the AG settlement and things like that, and then went off to help manage our default operation because we were being threatened by the GSEs at that time that they would pull servicing, which would have tanked our auction, all kinds of complicated stuff. But essentially, I got a real crash course at that organization in everything mortgage finance, both origination and servicing, the operations side of it, plus the finance side of it, which is very difficult for a lot of people. Don't really understand the secondary market and how that all works and how that drives housing. And I think, I used to do training courses, and I'd say unless you understand mortgage-backed securities, you do not understand, mortgage finance or housing. And so anyway, after that, I went to a bunch of non-bank originator and servicers trying to help them get their operations in shape. Once I sort of got frustrated with that, because technology was the answer, and their technology is abysmal. 1968, 1972, or when most of the banks and non-banks use systems that old. I kind of went out to some fintech companies and tried to create solutions for the industry. And then, I sort of, at those companies, just because of my background, I have a background in academia, they sort of came to me and said, hey, tell us when rates are going to rise. And so I did a deep dive, and really for the past 4 years have just been studying macro as well as kind of the micro of the housing market, and then went out on the road earlier this year just because, I had a thesis about inventory. I believe that the shortage narrative was overblown. And so I went out on the road to see for myself. So that was a long answer. Hope that kind of gives you good background.
Yeah. So I'm curious about, you mentioned solutions to fix the industry. I know we want to talk about the market, but
Yeah.
I'm curious, what do you think is wrong with the secondary lending industry as well as just the mortgage industry in general right now?
Yeah. So to me, there's a lot of things that are wrong. I think people don't understand that 95% of the mortgage market is, backed by the government. I think the private market is the official private market. I've been learning a lot about the private note market recently, but the official private market, our non QM as we call it, is only about 5%, and that's drastically reduced from what it was prior to the GFC. So what's wrong? I mean, I think that the incentives are not aligned correctly. I think the government has made it such an unwieldy process. The banks really got out of it. The non-banks are sort of driving it, so I think that we've lost sight of I don't know how this really should operate orderly, and now it's just become another government program. I hate to put it that way, but that's really what mortgage is today.
Like, I wouldn't completely disagree with you. In terms of going and going in something we might disagree a little bit on, I'm curious what you see the current state of the residential market is, be it multifamily, short term um, uh, occupiers purchasing. What are you seeing right now in America's housing market?
Yeah, so it's a very confusing story right now. And I think that wherever you turn, you could find something to support your position. And what I try to do, honestly, I mean, honestly, is I try to look at all of it. Um, and I try to triangulate the data to understand what's going on. And I try to dig into each of the data series because let's take Case Shiller. Everybody's in an uproar. Case Shiller, on the rise, home prices, right? Well, that's just for existing. That's just for repeat sales. And the series that came out, this week is honestly for sales in, June, July, August that really got into that September number. And so it's very lagging. And it doesn't, and again, it doesn't even take into consideration the new homes, which we saw this month, new home, median price tank. And so you have this very disparate picture of what's going on. And so to me, you have to be really thinking about path versus prediction and what I'm seeing, because I do still have mortgage clients, is I'm seeing distress at the consumer. And what you hear out in the media is about aggregate delinquency and the fact that 90 plus is down. But in reality, the reason the 90 plus is down is because of all the government programs were there, catching them in the COVID forbearance, catching them in the payment deferral or the partial claim, things like that. But the 30 to 60 is starting to tick up again. And in mortgage, we call when you cross that 30 plus, we call that the death cross because it means you're giving up on your credit reporting. Now, so what's happening with a consumer there? It's a combination of people that can't afford their property taxes, which are increasing exponentially, especially in places like Florida. And when I say California and Florida, people are like, oh no, there's a cap. Well, yes, but this is about people that bought recently who are they bought in 21 and 22, and that's not applicable because there's this thing in California called supplemental taxes. The point is, expenses are rising exponentially and the consumer's coming under stress. At the same time, in my books, I can see the investor, the smaller investor coming under stress who had multiple properties, over leveraged, weren't prepared for the types of expenses, etc. So we're seeing that early stress in the consumer in the mortgage industry. And mainstream media is trying to kind of say, well, 90 plus is down. I don't care about 90 plus at all. I mean, we're going to have government programs that are going to help people, with that delinquency. We just saw VA go on, a pause for foreclosure. I'm not really looking at mortgages where I see the biggest distress in the market. Where I'm seeing it is actually in these all cash sales, which were people who, yes, of course, there were definitely people who bought with all cash, without a doubt. But a lot of that was leverage cash from like wealth management, groups at PNC and places like that, or they refied out of a larger property, through a DSCR loan or things like that. And so it looks like it was purchased with all cash, but in reality, that's leveraged somewhere else. And so I think that the investor participation kind of went wild. If you look down in Florida, somewhere like Lakewood Ranch, I mean, it is completely obvious to you, Port Charlotte, Port St. Lucie, these places that have just become completely overbuilt because and built for speculation. So I think that the path that I see ahead, if nothing else happens, if we don't have a credit event, if we don't have enormous job loss, we will see material delinquency in mortgage probably around June. That's when I think people will stop arguing about whether or not there's issues in mortgage. Again, not my biggest concern. But what I'm already seeing in Florida specifically is you're seeing investors trying to offload properties and they're not able to. So I tweeted out something yesterday. You may have seen it. It got a lot of, I kind of had no idea it would get this much. It kind of went viral, but it was just of one home in Fort Lauderdale that I had actually went to, a few weeks ago, and this was a fix and flip. I mean, they kind of covered over the garage, tried to make it a 3-bedroom. I mean, it was really poorly done, and right next to a substation, and they're trying to sell it, for a crazy amount. And it recently they're starting to take the price down, take the price down, take the price down. Now, I know other situations. So I study a lot of Florida because I think, based on all my travels, I thought Texas would sort of be the epicenter of what I'm seeing ahead, but it's going to be Florida again. It's always Florida. There's a great book, Bubble in the Sun, and another one called Swamp Peddlers that just really kind of can lay the groundwork for understanding Florida. But essentially, you're seeing it, the inventory where, I'm seeing inventory drop in certain places across the country. Florida is just there. It's starting to come on at an accelerated rate, and it's sitting on market. It's not going anywhere. And so you can, and I talk to a lot of people because I get a lot of hate as well, and but we
I
talk
would,
it out.
I would,
Go ahead.
yeah, no, I'm sure you do get a lot of hate. I got a lot of hate yesterday for a comment I made about the housing market, and I'm
Yeah.
much more agnostic on it than I think you are. So I can only imagine what you get in your DMs. In terms of going back to something though, I wanted to double back, and one of the reasons why I think I'm more agnostic is I don't have the numbers in front of me. I see a lot of just really mixed data, and a lot of
Yeah.
it seems to be very lagging. So, like, I know recently you were on the Hartman show, I think, and he's a bull, a housing bull,
Yeah.
and so he's sitting there and he's using all these major government numbers that are put out and major corporate media numbers, and a lot of them show a pretty good housing market. But then you're seeing a lot of voices like yourself that are very knowledgeable in the market who are coming out with their own data pools that show a very different picture. And I'm curious, can you explain a little bit more about why you think data might be lagging so much? That we're seeing right now, because I know as somebody who's not primarily invested in the residential space, that's a really small part of our portfolio, but it's still important for our investors to understand what's going on. Why do you think there's such a disparity? And can you go into that a little bit further?
Absolutely. But let me just kick off with I agree. It's important, I think, for your audience to hear about residential because I do think they're inextricably linked, and a lot of these new builds were built to support commercial projects, believe it or not, So, why? Okay. So, back during 2006, 7, 8, 9, even 10, I can tell you, we had reason to be positive about the housing market based on the data that we were receiving because it's not that anyone's trying to obfuscate. That's not what I'm saying. It's like you take the case Schiller again. It's repeat sales that's existing. That's a very limited population of what's going on. Also, a lot of the data that we look at is on surveys. And what we've seen absolutely since COVID is that there's a reduced participation in surveys. So you have one of the reasons I started doing what I was doing, which is tracking stuff weekly, is because I remember being fooled, very fooled, back in the day by the data that we were all seeing and by the leading economists. Like, I won't mention names, but every single one of them was very wrong, very wrong. They've been wrong this time as well, all the way through. But people continue to listen to them. I don't understand that. But anyway, but again, they're looking at this lag data, but it's also aggregate data. And what I can tell you absolutely about, real estate housing is that the local component matters a lot. Now, it will become a national story, but it will start locally. And if you don't understand those local dynamics, those micro dynamics, you're going to be caught by surprise. So, like yesterday, the Florida thing that really, got me some hate just because so many people are invested in Florida, right? And this guy was arguing with me about, the price. You're the only one, Melody, that's saying, well, I'm seeing reduced prices in Florida, and including existing and new together, because I'm using a different data series. It's not the only one I use. I use all of them to really understand what's going on, but it really has to do with the lag. It has to do with the idea that you can look at something in aggregate and understand what's about to happen. That's just not the way it works. And a lot of people look at MSAs. They don't even look at local. I mean, can you imagine like the Atlanta, that area? I mean, that's about what, 100 different markets, that they're trying to, and so you can smooth that data series. That's not going to help your investor who's in Alpharetta, with all this empty property, like commercial property or whatever. You know what I'm saying? That's just an example. I don't even know if that's true. I was there recently. It looked empty, whatever. But that's the part people always get surprised because they can't see the embers. They can't see the smoldering when you're looking at aggregate lagged data. And and I can tell you the bulls are about to be there. You can already see it happening. They're really shocked. They don't understand why inventory is growing right now. Well, meanwhile, this is exactly what I knew, at the start of the year was going to happen based on the short-term rental craze, which has not stopped. No matter what, what we know about kind of the increased expense, like the cap rate's not making sense anymore. We still got people piling in at the end. It's the last people in the door. And listings are still increasing for short-term rental in the 75 cities that I track. Even when we all understand, those of us that understand cash flow, et cetera, that, these markets are oversaturated. They're maybe around 50% occupancy. So they're not cash flowing, but people are still piling in. So I just think that if you look at just one or two metrics on the housing market, which is what everyone does, which is what we did during the crisis, you are always going to be misled about what's going on. You have to also look at demographics, which is something all the housing bills are just ignoring. And the census just came out and said, by the way, we had it wrong. We have even lower estimates of population growth. And that was last week. And we had already seen, Harvard coming out saying we had pulled forward household formation and we were going to have reduced demand in the future. But all the housing bulls ignored, they talk about supply. They don't really talk about demand. So lagged surveys that don't get, it's a survey. That just creates a very muddy picture. Yeah.
Look, the most hate I've ever gotten in a DM series was about 6 months ago. I made a big statement on Twitter about how demographics are going to drastically potentially lower the real estate valuations and expectations over the next 50 years. And you could not believe the number of people in markets like Texas,
Oh,
Florida,
yeah.
Arizona just came
Arizona.
into my DMs just trashing me. And look,
Turns
like we,
off.
we try long term to provide. Well, I have so many good ones though too. Truthfully, I've had some of the most prolific, great conversations with people who are
Yeah.
not, I'm not going to name in my DMs as well. So I'm never going to turn them off. I'm just going
Yeah.
to, try to have some peace and some grace.
Yeah.
In terms of going through and understanding though about some of those markets, I wanted to dive in to you mentioned Florida in particular, and like Florida is definitely a polarizing topic. It doesn't matter where you are on the political spectrum, the ideological spectrum. If you have investments there or you don't, what's going on in the Florida market right now?
It's just what's gone on since the 1800s, it's just speculation abounds. Like, there have been so many cycles. What was so amazing, because so something I didn't go into, I helped manage default in 2012, 2013, spent most of the time down in Florida doing that. And so you would not believe my shock when I went to some of the areas which were most impacted by the GFC to see that they were doing it again. I just could not believe it. Lakewood Ranch, and I will get some hate for this, I'm telling you right now. But, a lot of the residents, and my last Lakewood Ranch post, I got a lot of people saying, we overpaid, blah, blah, blah. But the amount of speculation there is just unbelievable. I mean, I can't even explain it. And they're just building, 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 building. And they're not looking around to see, does this make sense? And the big thing is you have, I'm a big fan of Ivy Zellman. She has this great survey of builders. She called the housing tops both times. She called the crash last time. She used to be known as Poison Ivy. But I think this time she's starting to get more bearish. I mean, she was very bearish for a bit. She's kind of said, it's not going to be as bad, blah, blah, blah. But she's starting to get closer to where I am but the reason why she's been a little confused is she only tracks the national builders plus a very small amount of not national, local builders. When you go on the road, what you can see is that in every one of these mega sites with the nationals, the smaller builders kind of glam on. And so no one really realizes, even if you're a national, if you take a left from your subdivision and just go a few blocks and another left, you've got three more that are that have sprung up because city planners have disappeared. They've just disappeared. And this is going to sound, are there in on sort of, this is a lot of money coming into their location and they've kind of like, okay, surely it's going to work out, but it's not. And so it's just rampant speculation. Everyone thought that either they could build a home that, one of the biggest things in kind of central Florida are the built for rent. And so everyone kind of got in like multi-level marketing. They say, hey, I want to buy one of these properties that I can rent out and get passive income. And so whole subdivisions are springing up of this built for rent. Meanwhile, though, there's plenty of multifamily at the same time, brand new multifamily. We're building multifamily the highest since the 70s. And so you've got all of this, you've got to look at all the housing stock together. But most of this has been driven by pure speculation and not anything to do with really, kind of meeting the housing needs out there. Because when you also go out on the road and see what these things are listed for, no one in those areas can afford them, nor can people on a fixed income, which is, who is largely drawn to Florida.
So let's go into the data here if we can. In an example in Florida, is the disparity primarily in understanding local builders versus national builders? Just the data doesn't exist, and And if so, what data do you have to indicate that there's as wide a gap, or is it predominantly, on the ground knowledge?
It's a combination. You can look at the permits and you can see that, there's been a ton of permits pulled to do this work. The problem though is that the permits are also a survey of construction. And so I think that, they don't, and we had delays during COVID. Well, firstly, let me tell you, there's over 3,000 counties in this country, and they have technology like that we were all
Yeah.
playing on in the 1970s. And, they still use pencils and fax machines. And it's not every county, but it's a lot of them. And so then they were the places that shut down during COVID as well. And so you could have a permit delayed in recording somewhere like Angeles for months. And so I think there was a confusing picture of how many permits were actually pulled and for what, as well as on top of that picture, you have actors, investors coming in like American Homes for Rent, who built all this built for rent. And so that didn't show up, for instance, as single family residential. But then when they couldn't rent it, they sold those all as, single family homes. And so there's all kinds of noise in that data. And again, I'll go back to it's a survey. We've seen reduced participation. But then the reason why I had to get on the road is because the data didn't make sense. And until you stand in one of these mega sites, you cannot get it at scale. And the thing is what happens is a lot of people think it's just that one location. But the problem is I've now been all across the country and it's everywhere. Not at the same scale. Like let's take somewhere like Pittsburgh or Johnson City, where I am right now in Tennessee. It's not like Denver, which is just one big new build site for multifamily and single family. And some commercial when the tech center is almost empty. But here in Johnson City, there's probably about 9 or 10 of these developments of about 30 homes that are never going to sell at the prices they think, upward of 500,000. I think the median income here is $45,000 household income, and they're just sitting on market. And most of them aren't even listed. Most of them aren't. You'll go to a subdivision, it's one listed, there's 30 other homes. Because if you got no interest in that one, why are you going to make it look like there's more? So it has to be a combination of looking at the data, and the data even in Florida and Texas tells you that there have been way more permits than what's needed for actual, the households out there in terms of, be it multifamily or single family, residential. So, it's a confusing picture, but you have to look at it all together. And what I would say to people that don't believe me is like, just get in your car, pull up the Pulte map. Usually there's one in your city, and Pulte New Homes, your city. Just go drive that. And what you'll see that all the builders kind of go to the same areas. And then the local builders also are there. And so, I think a lot of this is just about when we drive to work, we drive the same drive. We don't really look around us. If we drive just a little bit different route to work, I think people are going to see what I've been seeing out there.
If somebody wanted to go and dig into data, do you have data on your Substack or that folks can look at to kind of get a better idea of what's going on? Just because our listeners are very educated as a group, and they always like to dive into things.
Yeah.
I know we're going to go back to our conversation, but is there a good place on your Substack or somewhere on your website that they can check out some of this data?
Absolutely. So I'm hoping to publish today, Gordon, today or tomorrow, my monthly summary. And in my monthly summary, I have 75 cities, and I put in there, listings for rent, listings for sale, listings for short-term rental, median home prices, the change in homes sold, et cetera, for all those 75 cities. And so there's a ton of data. And then every week I kind of publish, because I track this weekly. Every week I publish the updates for those 75 cities for the listings for sale, rent, and short-term rental, because I think that's what most people, the housing bulls out there, they look at these markets very differently, the rental market versus the for sale market. And when rent is now, when it's now cheaper to rent in most cities across the country than it is to buy a home, and that has flipped on its head, then you have to understand that the multifamily and the built for rent are going to be competition for your existing and new home sale market. And that's what a lot of people are missing. So, absolutely, they can come to my Substack, they can dig into the data. And honestly, if they leave me a comment on my Substack, I'm happy to talk to them about the data too, as well, in specific areas. And a lot of my Substacks do dive into specific locations. That's how it kind of started. My first post on Substack was when I got back from Phoenix and Las Vegas. So, I also do deep dives into particular cities, and can also, help people if they want to do the same thing in their city, kind of give them some advice on how to get that data. As well as I track the permits and things like that in the background. There's a couple of great, um, you know, great stacks on actual permit data across, and some visual maps of where all these permits have been filed, et cetera. So yeah, highly recommend for the data geeks, because I am a data geek. I want as much data as I can get. Um, I'm a total geek in that way too. And honestly, that's what I do. I just watch the data. I'm not trying to superimpose my feelings onto the data. I'm just watching what I think is about to unfold, a lot of which is based on my knowledge of the mortgage market, but also just what I've seen on the road.
Like, that's a lot of what we do here as well. We're just trying to help investors make good decisions. And one of the things that I'm curious about is trying to figure out why we have such contrasting stories, right? We have this whole idea that, from your perspective, that we're about to see a major correction potentially. And then we have the main media narrative is all, there's a housing crisis, there's a housing crisis, there's a housing crisis. We need more building, right? So why is there that gap? Um, because for a lot of people listening, they're probably sitting there and saying, why are there two completely different narratives going on right now?
Well, I think you just said it, narratives, right? They're narratives. They're narratives. They're driving a certain view. And we have to understand. And, I'm not trying to be conspiracy theorist. I just want to educate people. But realtor.com is owned by the same folks as the Wall Street Journal. Like every single one of Zillow and Redfin are out there selling. You have to understand there's vested interest, but we just take it back to Upton Sinclair, right? Eh, a man's going to believe something when his paycheck depends on it, and so I don't even, I don't have any judgment, honestly. I just want everyone to actually have all the facts to make a decision. But I think that a lot of it is narrative. Like, you take, for instance, what happened this year with kind of everybody was surprised by new home sales. I honestly, I was not. I'd written an article because they came in and they did incentives that basically affected a 15 to 25% net reduction in the price. But how did they do that? Well, the media kind of went out full court press saying, hey, everybody, you can get this new build for cheap. I was very nervous after seeing all these empty subdivisions in places in like Round Rock, Texas, et cetera, that some young couple was going to end up in a subdivision and they'd be the only house there, or only occupied house. Because I had seen fully complete subdivisions all over the country not occupied, which are a security risk. So I just had nightmares about this. So tried to tweet like, hey, just think about these things. I'm not saying don't do it. Just think about these things. But the Bloomberg and everybody was just like, go out and buy these things. And you could see it as the stock market was kind of, doing better. New home sales kind of tracked right along with that. And so I think that the same fundamentals were there. The prices were unaffordable, but the builders were, definitely had to figure out a way to move this inventory. They're just like retail. They like a store, they have to move their inventory. And so what do you do when you have to move your inventory? You cut the price. And but then on what I've learned is that when they put those sales in MLS, they don't have to put all the concessions. And so it looks like the prices they got were much higher, which then sustained everyone's belief that these prices were higher, even though people were getting these concessions. And so, I think it's just there's a narrative that wants to support what they hope to be true, just like the soft landing. And again, like you, I'm here to educate. I'm not here to predict. But I can tell you that what I'm seeing in sort of escrow notices that are going out, doubling payments in insurance in Florida was 4 times the national average before even what's recently happened, and you have 1.8 million on the government insurance down there. Like the expenses are about to drive a lot of people out of the housing market. And for whatever reason, I think maybe, you know, the top 20%, it's an echo chamber, and they don't understand, they don't experience life that way. They talk to, their friends are mostly doing okay. Although even when you talk to them, the super prime are starting to come under stress. Many of them have taken on way too much leverage, house poor in these mansions, and it's kind of crazy. But I think when 57% of Americans can't afford a $1,000, dollar emergency, the idea that there's going to be demand for homes that are pricing out over $400,000, I don't care what the interest rate is. I'm telling you right now, I don't care. They cannot afford these homes plus the expenses that go along with them. And it's just like I think our media misunderstands who lives in this country. Yeah, the top 20% drive a lot of consumption, but there's a limit to how many houses they need. And by the way, they're not going to buy 100 when there's nobody, like 100 to rent them out when there's nobody that can afford that rent. And they need that rent because they just paid that much for them. So if they want cash flow, they're going to have to get a certain amount of rent. They're not all like super, super rich, right? They're trying to make money. And so I think everyone's misunderstanding the demand. The fact that all those homes that are being built, they're very expensive to build, or were very expensive to build during COVID because of labor and cost of materials. And so I'm not saying the builders are actually trying to scam anybody. I mean, those things were really expensive to build. The unfortunate thing is there's just not enough people to afford them. Hope that
So
helps.
I'm going to play devil's advocate really quickly before we move on to our next subject. And there's certainly some investors that we've worked with that have a little bit more of a tinfoil hat. And some of them uh, firmly believe that between 2021 and now, there are a lot of builders, particularly in like 2021, 2022, that were selling a particular narrative with the intention of offloading product that they knew might be um, less than advantageous to hold. Do you think there's some truth to that potentially, even if it wasn't done consciously? Because it seems like from the data I've seen, there's a large percentage of folks that were in the national large, REITs, large housing groups that offloaded a tremendous amount of product in 2021 to 2022 to much more mom and pop shops. Do you think there's some validity to that conspiracy, just even if it was done not consciously? Or am I just smoking something good?
No, I listen, there's so much greed out there. I don't even, there's this great article by Michael Pettis from the Carnegie Endowment called The Bezel. And it just talks about how much of the bezel really participates in every one of these cycles. And so, I so for instance, the nationals, can they control what their local builders do? Can they control you've got so you think about it, you oftentimes you go to these builder sites, you talk to people there, they know more about what's going on than the nationals. And there was a great Twitter account, New Build Guru, earlier this year was like, we are being forced to write contracts Even though we know that though they're never going to make underwriting, because you can book it as a sale at that very initial contract, whether they go under underwriting. So was that happening? 100%. Like there's no doubt people were pushing product, pushing the numbers. But usually that's because someone's told them, hey, you're not going to get your paycheck if you don't do X, Y, and Z. And so I wish that we were all, super ethical actors, but in reality, most people are just trying to feed their family. And so, and then there are the crop of just totally, fraudulent actors. And so I think it's a combination of those two. And I don't think that's tinfoil hat. I can tell you absolutely in February when I was in Austin and in Charlotte, Nashville, and all over Florida, they were pretending like those homes were occupied. They were doing things like pushing garbage cans down, but I was told by people in the industry how to tell the difference between what was truly sold, what was truly vacant. There was always some kind of indicator, be it a light was on, or the sticker that said sold was green versus a red sold sticker on another property. So it's called salting the lots. And so everybody was salting the lots. And so you have to kind of ask yourself, is that an okay marketing technique? Is that, it's not one I would employ, but we do a lot of stuff like that in every industry. So, but I do think there are a ton of bad actors, and the fraud's just starting to show itself. Like, people coming in and saying, "Hey, do you want to get in on this new property? It's going to be units of $1.3 million," and taking $100,000 of people's money. There's a case I tweeted out 2 days ago in Davie, Florida, just like that. So there are a ton of bad actors, and we're just starting to see those come out of the woodwork. So I think it's a combination of probably ineptitude, kind of a little creative marketing, and then your bad actors, honestly.
Yeah. So in terms of going through, there's one more elephant in the room that I know we'd like to talk about, and that is the short-term rental world.
Yeah.
I know you've talked at length on some of your Substack about short-term rentals. That's probably the hottest. How do I put it? The hottest touch point when
Hottest off
I
the
engage with people who are kind of like the yeah, yeah, some of the folks from like the Bigger Pockets gang, and so I just wanted to see what you see in terms of the short-term rental market right now in the United States, and if you could maybe give us a little forecast of what maybe potentially might happen over the next, let's say, 36 months.
Yeah. Yeah, I feel for people that kind of fell for this hook, line, and sinker, because, and I think there were a lot of reasons why people don't fully understand. I'm going to quickly start with Airbnb and the fact that anytime you look up, a city, they will only give you 300 results. And it will also say in the top left hand corner, there's 1,000 plus Airbnbs in this city. Well, what they don't tell you is that there's 14,000 of those in Austin, for instance. And now, what if you are one of those Airbnb's owners in Austin, and you don't realize that Airbnb is not going to? You're never going to get up to the top, no matter how you set your filters, no matter what you do. There's a real possibility nobody's ever going to see your listing, and they aren't going to tell you how many Airbnbs are in Austin. You would have to, sign up with a service like AirDNA or Mash Advisor to understand that yourself. Well, and those take the rosiest picture. I don't want to out anybody in particular, but let's just say they take the averages. They don't use real time data, and it's a month delayed, and the comps are completely off. Like, so for instance, in one of my Substacks, I take a property in Kyle, Texas. It was one that was actually in one of my clients' portfolios. I looked it up in one of these. I have paid subscriptions. It told me I was going to have a $600 average daily rate, and it would be occupied over 60% of the time. Okay, this is Kyle, Texas, 22 miles south of Austin. I can get a $600 right downtown Airbnb. I'm certainly not going to pay it. And this thing was just a spec home. It was just a modular spec home, nothing fancy, nothing great. And so I'm a lender. How do I underwrite for for short-term rental? Well, I use some of these programs to do my comps. Okay, so then what happens? You're making loans on completely failed comps, and so the biggest problem that I see is the oversaturation, the complete mania. I've got Twitter spaces out there where talking about homes going on Facebook and under going like getting sold in under an hour on Facebook. I mean, just pure mania. And most of the people I've brought people on that got out in 21, 22 could see what was happening, but most people can't because they don't have time to really look into this. They get a pamphlet that says all the right things, and it says this can be yours for blah blah blah. And if you go to XYZ lender, all you have to do is put down 10,000, and then that lender is going to say to you, "Hey, by the way, you really should get multiple properties, not just one, because it's just better, and use that leverage." And so what you've got is a real mania mess where people thought that, because think about a long-term rental. Maybe you make 2,000 a month. Well, they were telling people, "Hey, instead of 2,000, you can make 10,000." But if you go to somewhere like Asheville today, Asheville, North Carolina, there are three listings for every one listing for sale for Airbnb. So three Airbnb listings for every one listing for sale. These markets are completely saturated, and they've kind of transitioned to everybody has decided to be a short-term rental landlord, taking off housing inventory from the market. And there is just a limit to how much short-term rental you need in cities, especially since there are also hotels who are going to be competing against you because they get it now, and all of them now have their own short-term rental businesses, but they understand what they're competing against now. They're out there lobbying, because that's the other headwind that is all these regulations that are coming out, like in Dallas and New York, that are really going to put a crimp in these markets. And it's happening everywhere because people are mad. They're mad because a lot of these short-term rental operators didn't do a good job managing these properties, and they were in residential neighborhoods, and nobody wants their kids waking up to beer bottles in the yard. Like, that's just not. So there's a lot of zoning, there's all taxing, so the headwinds in this market are absolutely unbelievable. And I think that people just got in, because they believe the hype, and they also believed the providers in this space. And they have not, in my opinion, been good actors at all. So it's not looking good and at all. That property that I was tweeted out yesterday in Florida that I had been to, they bought that for short-term rental. No, that thing is miles from the beach, 5 miles from the beach. Nobody's going to give them the money they need to cash flow that property. It's just not going to happen, which is why he's selling it. And it says, short-term rental ready or whatever. And a lot of actually, I have a colleague in Nashville sent me a note. He scraped the MLS data in Nashville, and I don't have the exact numbers, but the percentage of homes that are making it to the market that were short-term rentals outweighs everything else. And I hope to share that soon, the actual numbers in my Substack, because it would be the first case study of something that I knew was going to happen, which was we were going to have short-term rentals come to listings for sale at an accelerated pace once everyone sort of realized that they weren't going to be able to cash flow the way that they had hoped. So it's not looking good, Gordon. There's a ton of headwinds. Now, could you be successful in this? Absolutely. But it takes a lot of work, and there will always, I think, be a short-term rental market, but you have to actively manage. There's no such thing as passive investment in housing, in my opinion.
I mean, look, I have some friends who have done it very successfully. They're very active managers, and they're in prime markets, places like downtown Miami, places like Milwaukee, all by the breweries, where you sit there and you say, yeah, that's probably going to work pretty well. You're just essentially operating a more diversified hotel lineup
Right.
versus there's definitely some people who came into markets like Lake County, where I sit, who were in a mode where they were trying to create short-term rentals 30 miles from Chicago. And I have a friend who exited the market in 2021 because people were buying his properties for short-term rentals, and he said, "We are selling tulips."
Yeah.
So, look, there, there are certainly never clear answers, but I think there's maybe the clearest answer of all is we might be in for a change in the next couple months. So, in terms of going, we've had a wonderful conversation thus far, and I wanted to see if we could move to our final four. It's a great opportunity to wrap things up, and it's a great opportunity to learn a little bit more about you.
Sure.
Uh, so, where do you see the housing market going over the next, 10 years?
Yeah. So if nothing changes, if we don't get a credit event, if we don't have additional, kind of job loss, I think that we are going to have a slow home price correction. So, a lot of people think that I'm saying it's going to crash overnight. No, I think next year we could see something, probably around a 5% decline, but then 25 is, if nothing else happens, I think 25 is where the rubber really hits the road and we start seeing significant declines in house prices. And I think, then we have probably 2 to 3 more years of smaller declines. And we kind of revert back. I see anywhere between a 30 to 40% correction in some markets. Some don't have that far to go. But my biggest premise is looking at affordability. And, I ask people, okay, although we've seen wage growth, we certainly have not seen it outpace inflation. So, what is going to happen to make people be able to afford these prices and to even, afford to live in these homes, especially when you have the headwind of AI as well? I think it'll probably take a little longer than most think for AI to really come in and take jobs, just because I've been in technology and I know how long it takes humans to actually get their stuff together. So, I think it will correct. But housing is not a casino, and it truly is about shelter. And now I do believe you can invest in it. I'm not saying that, but it's not, as we've talked about here, it's not passive. It takes active management. And a lot of people are realizing they don't want to be landlords. And this is very similar to the setup of the Great Depression. Everybody became a landlord back then as well. There's a great book by Amity Shlaes, called The Forgotten Man, and it's all about that time. And it was always the regular worker that kind of got the short end of the stick, because they were just trying to work and do good and save a little bit of money, while everybody else went out there speculating, et cetera. So I do think that it'll correct. And then God only knows, we may see another run up and another, cycle like this, especially those that argue we have structural inflation. They definitely see hard assets increasing in price. I want to see what's going, who's going to be able to afford a $500,000 home on UBI. Like, that's what I want to, because a lot of people think that, kind of where we're headed. So what sense does that make? And then who gets to decide that? Like, who gets to decide who gets to live in what house? I mean, that's just a social nightmare. So, I think we'll correct. I mean, it is. I mean, there's going to be
Yeah, it is. Yeah, yeah, yeah.
some violence. I mean, that's going to be some violence. So I think we're going to correct. And I think then,
Yeah, who gets the lake view, right?
who gets the beach house? and
Yeah.
and I think that people are asking that question right now. The beach house that's government insured by citizens in Florida, like what? Like we're paying for them to live on the beach. So anyway, it's a social mess that we've got on our hands here. So, I think we'll correct. I hope we don't have another crazy run up, but we probably will because this is the way I mean, going back to the tulips, this is kind of the way that we always operate. So, as humans, hopefully we'll learn, or maybe AI will just come, squash us and take over and they'll figure it all out, right?
Look, maybe it's our robot overlords. I wanted to touch on one thing before we move to the next subject,
Yeah,
though, is demographics.
yeah.
If we could just briefly touch on that, because I know we mentioned it earlier, and I think that's probably the most perilous thing in the future. Maybe I'm getting our robot overlords wrong, but I'm more worried about the our graying overlords than I am necessarily our robot overlords.
Yeah, the demographics are abysmal, and you put on, and I honestly, my theory is they're abysmal because of our economic situation. I believe we haven't really recovered since 2007, that we've been in what Emil Kalinowski calls the silent depression. And essentially, we've seen so many people drop out of the labor force. We talk about low employment. Wait a minute, though. Let's look at how many people have dropped out. And then also, let's look at what kind of employment they have in terms of, they're working multiple jobs just to make the bills. And so, we have a lot like 2 million men that aren't in the workforce. Like there's just some crazy stuff going on where people believe they cannot make a living, they cannot get ahead, they cannot buy into the American dream. And I think that couples are absolutely kind of looking around and saying, well, if I have a child, how am I going to support us? We're barely making it. And so I think that a lot of the reason you've seen reduced demographics across the world, but here as well, is that it's just too expensive. They can't afford childcare. So we kind of, we kind of brought women into, the workforce, and that gave us a bump for a little while. But then as childcare became more expensive, that's not going to work out. Everybody's working, working, working so much they're not having kids. And when you don't have increasing, productivity fueled by labor participation, then your economy is in some deep trouble. And so I am very concerned about our demographics. I'm not as concerned about ours as I see across the world, but we've got a real problem on our hands. And I think people have gone from thinking there's too much population to, oh my gosh, well, what are we going to do? So it's absolutely, to me, if we want our economy to be robust, we're going to have to figure out how to get more people participating in the labor market.
Look, I certainly could go on a long diatribe on how much I hate Malthus, and I certainly wrote some serious college and even a law school policy paper on that. But on a completely different note, let's take it to looking back to your childhood instead of maybe the absence of a lot of childhoods in America. Um, what would you say if you could go back in time to high school, Melody, and tell her a little bit more about her future and what advice would you give?
Don't take out student loans. Be so I had no financial education. I grew up very poor. We lost our home to foreclosure when I was 9. So we knew nothing about money. The only thing I knew about money was write checks in red, because if you write them in red ink, they take harder or longer time to process. That's what I learned when I was growing up. So I would say go get a financial education, learn about money, learn about interest, learn about, what debt can do to you. Figure out what an amortization schedule is. Like these are things you're never taught. And so, and they certainly did not teach you when you went in and as a 18-year-old person who didn't have parents that were really participating, I signed all my papers. I had no idea what I was doing, zero idea. And then I would also say, never believe the hype. I went for my master's to one of the most expensive schools in the United States. That was just I mean, it was I don't regret my education, but I could have gotten that education, as they say in Goodwill Hunting, at the public library. Like, I didn't need to spend, and this is probably going to sound low to people at the now, but I didn't need to spend $30,000 a year, at NYU. So I think but for someone like me, I believed the narrative of this was my path to achieve the American dream, was to go to the right schools, get the right education. And what I soon learned is that really, that didn't matter so much. No, it has gotten me things that I wouldn't.
So I
Yeah, but go ahead.
Yeah, so I think that gets us to probably our next topic, and one of the questions we like to ask is about other ways to get an education. And the way I love is I love books. I'll admit I'm a slow reader because I'm dyslexic, so I definitely do some audiobooks as well. But do you have any books you would recommend that might help educate folks on the state of the economy, real estate? You've already mentioned a couple, which are great, but is there anything that you would recommend that our folks pick up to either read or to listen?
Yeah. So, I mean, there's a lot I would love to recommend, but I think the way I got started, I'll just, in this education recently in the last 4 years, is I picked up Daniel DiMartino Booth's Fed Up. And I think, reading Fed Up, because she is an incredible writer, her writing is just so, clean and tight. Um, it changed my life. It sent me on a journey, and so it was the first thing to send me on that journey. So if people haven't read it, I would read that. And then I would say, Bubble in the Sun. It's such a great book on Florida, but about, and it argues that really it was the Florida land grab that really led us to the Depression. And I would agree with that because, 85% of global wealth is real estate. I mean, housing, all of this really drives the economy. So Bubble in the Sun teaches you that it's not different this time, and that we sort of cycle around this. Our History of Doom is another one that talks about all these different economic crises or panics in the history of humans, and this has always happened and it's going to happen again. So just be on the right side of it. Understand what's happening to be prepared. So I know that was a bunch versus one, but I'm a huge reader too, but I also
Look,
listen to audiobooks too, Gordon. So don't, yeah.
like I read. I just for me, I sit there and I think I read at probably one third the pace as a lot of folks. So if I'm trying to get something quickly in my short time on this planet, sometimes audiobooks is a better option.
They're awesome.
So
They're
I
awesome.
wanted to touch on I wanted to touch on our last topic, and it's the whole reason for the podcast. It's to go out and reach out and find interesting people that have interesting ideas, and it tends to be men and women who are in the arena, who are, either just as you talked about it, going to talk to people who are maybe on that construction site, or people who are doing those transactions, or people who are talking and analyzing those transactions, like you. Who's the next person we should get on the podcast?
Ooh, okay. The next person you should get on the podcast, and I don't know who all you've had, but honestly, I would bring in, I think someone like, if you could, this would be a big ask, but someone like Lacey Hunt, or someone like Danielle DiMartino Booth, both who have a very good handle on the economy and all of the forces that impact it, because it's not just one thing. There's so many. It's such a huge ecosystem. But I think Lacey Hunt, a macroeconomist, is an amazing person to listen to in terms of his understanding of the cycles, and understanding as well how cars and housing really drive the economy. So, that's a more kind of scholarly, but I think it would be, interesting to the audience.
Hey, I totally agree. I'd love to reach out to them and see if they'd hop on. I know we're going to have a couple economists in January come on and
Cool.
kind of give forecasts, one even very long term, like 30 to 50-year forecasts in terms of demographics and kind of what they see in terms of long term cycles.
Yes.
And so, thank you very much, Melody, for coming on. There's one final question to ask, and that's simply, how does someone get in contact with you? What's the best way to reach out, and where can they find you?
Sure. So, I'm on Twitter at M3 underscore Melody, and you can at me. And if you at me and say, hey, I have a question for you, I will reach out to you in DM. So Gordon, the DMs I should offer the ones that are not, that just kind of cold come in, just because it was really more overwhelming. But on Twitter at M3 underscore Melody, my Substack is M3 Melody Substack, and then on YouTube at M3 underscore Melody YouTube, and then of course on LinkedIn at Melody Wright, and so I would say the best way is typically on my Substack. I can always get to those comments. It's been a little bit of a challenge, just because things have been happening quickly for me in terms of keeping up with YouTube comments, etc. But at me on Twitter, if you at me, I will reach out to you. I typically read all those notifications, and if I don't get it the first time, try again, because it's not because I'm ignoring you. It's either because I didn't see it or I'm just a little bit busy. But very open to talking and discussing, and typically I'll share my email once we get to a certain point as well. So
Melody, thank you so much for hopping on the podcast today, and we'd love to have you on in the future.
thank you, Gordon. Thanks so much for having me, and it'd be a pleasure to come back. Thank you.
Thanks again to Melody. If you enjoyed the podcast, please give us a like, a follow, a review. All your interactions matter, and they help us get great guests. You can follow us on YouTube, Spotify, or wherever you get your podcasts. I'm Gordon Lanfear with the Real Finance Podcast. Thank you for listening.